Ladies and gentlemen, welcome to our investing podcast. Today we have a very special guest, Mr. Rick Ferri, a chartered financial analyst, one of the most famous experts in financial analysis and advice for do it yourself investors. Mr. Ferri is a former US Marine Corps officer and fighter pilot who started his investment career in 1999 as a stockbroker on Wall Street. Now, he's helping individual investors like you and me to customize their portfolios based on their needs and the low-cost investment principles. He's also the host of Bogleheads on Investing podcast. It is a great honor to have him with us today into our Romanian investing community. Without further ado, we say hello today to Mr. Ferri. Thank you very much for joining our podcast.
Thank you for having me today.
Okay, so the topic of today's podcast would be how to reach our goals as retail investors with passive investing. I would like to say a few words because here in my country there are some types of clusters created. So, for instance, there are those who earn a little bit more money and would like to allocate those money into private equity markets because they somehow feel they have an edge um, over other investors or at least over public equity markets. Of course, they don't think about it as uh, offering also higher risks in terms of liquidity, in terms of concentration, maybe leverage, why not, and so on and so forth. But some investors who have some money invest in real estate, also thinking that this is a higher yielding asset. Of course, yield is not a factor in investing, but they somehow believe that getting a higher rental income would mean a better prospective returns. On the other side, we have those teenagers who maybe don't have much expertise and also capital, who'd like to gamble a little bit to speculate because they say, 5% it's a too low return for me. I'm a teenager and I would like 500%. I would like to invest in Tesla, NEO, those hot stocks, or maybe why not, Bitcoin, because cryptocurrencies, even though they have no internal rate of return, they have what? They have volatility. And people like to gamble volatility thinking that it is a prospective return. What do you think about these two mindsets, which both of them have almost nothing to do with investing, but which are common among retail investors? I don't know if only in my country or also in the United States of America there is the same thinking pattern.
It's worldwide. It's not country specific. When young people who are speculating on individual stocks or the price of Bitcoin, and they don't have a lot of money, it could actually be a very good learning tool. Because we know most of those people are going to lose eventually. You might win for a while, and if you win, you'll bet more because you want to win more, and eventually you lose most of it. And then at that point, maybe you start looking for something a little bit more sensible, more long-term, and you discover other ways of investing that are more long-term. So there is a benefit when you're young and you don't have a lot of money to go ahead and speculate and try to figure it out because you're not going to. And, you could get lucky. Remember, when you flip a coin, it's either going to come up heads or tails. So you could get lucky. The problem is if you flip a coin 4 or 5 times and you guess right 5 times in a row, are you skilled at flipping coins or are you just lucky? Now, most people would say, well, I'm just lucky that I flipped a coin 5 times and I bet 5 times and I won 5 times. But they don't think that way when it comes to picking stocks or picking Bitcoin. They actually believe that they have skill. And that could be that's dangerous. So it is luck. I mean, the markets are going to either go up or go down, and whatever you bought is either going to go up or go down. And it has nothing to do with you. It has to do with whatever is happening in the market. And if you think it's you, you're going to be sadly mistaken at some point. And when you figure it out that it's not you, then maybe you'll step back and say, this is not going to work for me long term. I need to come up with something more sound, more prudent, a better long-term investment strategy. And so for most people, that is what that will lead to. Now, there are people who never learn that lesson. They never do. And these are the people who, for their whole life, are trying to find the one thing that's going to make them rich. And in the whole time, the whole world has passed them by. And the markets continue to go up, but their accounts don't ever seem to go up because they have fallen so far behind by trying to find that one thing they think is going to outperform that they never get the amount of money saved for in their accounts that they need at someday to live off of when they can't work anymore in retirement. So I would urge those people to realize that there's nothing out there in the markets that somebody else doesn't already know. There's no reason why you should know something more than everybody else. And there's a saying that what everybody knows isn't worth knowing. And so once you come to the realization that you can't possibly know more than other people, especially those people who are in the industry and working in the industry full time, and they don't even know what most of the stuff that they don't have any advantage, that it's very difficult. Now, if this is the public markets, this is the stock markets. Now, as far as real estate, buying individual real estate properties and getting rents from those properties, that's a different investment than investing in the public markets. We could address that, but if somebody was to say, I have both stocks and I have in the public markets and I have real estate holdings that I rent in the private markets, that's actually good diversification. So it really is two different types of investments.
Okay, I would like to say that in my country at least, some people consider that passive investing is chosen by those who are not experienced enough and somehow choose the easier path. However, Ibbotson had shown in 2010 that 75% of the volatility of return distribution can be attributed to uncontrollable market fluctuations, and only 25% can be attributed to skill coming from active management. So, actually, do you think that experience can take a role in investing or not? And also, what confuses me or intrigues is that when taking idiosyncratic bets, people don't even look at fundamentals, like saying, for instance, I don't know, Gazprom is a cheap stock and I am doing value investing and that's why I invest in Gazprom. But they prefer to invest in Tesla because they have a herd mentality. Even I think even the owner of Tesla said that the stock is overvalued, Elon Musk. So even if they want to get those returns, they don't look at fundamentals at all.
Well, as far as using index funds to just capture the return of the market, and that is a naive way of investing, my answer is I don't care that it's a naive way of investing. It outperforms most of the experts who are trying to beat the market. We have data here in the United States that goes back over 100 years, which compares the performance of just the market to professional portfolio managers who, even on a risk-adjusted basis, have underperformed. over a period of 20 years, more than 90% of all professional money managers underperform the market. So, individuals might get lucky. They may have bought Tesla at $250, and now it's worth whatever it's worth. It could have easily gone to zero. It could have gone into bankruptcy. I mean, who knew? I mean, what is it that someone in Romania knows about Tesla that people here in the United States don't know about Tesla? And so why should you have information? Why do you believe you have superior information about an investment? You don't have superior information. And you also don't have superior trading ability, meaning that even if you had superior information about a stock, you have to know how to trade on that information. So it takes two things. It takes superior information and it takes superior trading skill. And you have neither. So what do you have? You have a coin flip is what you have. You have luck. You buy, it goes up, you make money, you're lucky. You have to understand and realize that it was luck. It wasn't skill. That if it was skill, you would be able to do it every time. And you can't. So it is luck. And don't confuse luck with skill. Eventually, what happens is you run out of money before you make a lot of money. Your luck runs out. You don't understand it because whatever it was you thought you were doing in the past, whatever methodology you thought was working for you in the past, isn't working for you anymore. And now what do? You double down, you make larger bets, you change your strategy, you try something else and so forth. And eventually you get to the point where you run out of money. And once you run out of money, it's over. You're done. You can't go negative, unless you go out and borrow money. And I don't suggest doing that to speculate more. So you have this unlimited upside that you're looking at. But what's holding you back is the fact that when it goes down, you only have a certain level you can get to, and you can't go below that. And so you have to get out. You have to stop. And all of this is what happens to speculators. They make some money, they think they're skillful, and then when they eventually lose the money, they have to get out, and it's over. You don't hear from them again. And then when the next boom comes along, the next hot stock comes along, Bitcoin, Tesla, whatever, you got a whole new group of people who think that they're smart. And I've seen this for 35 years. They come and they go, they come and they go, they come and they go. Every time there's a boom, bust, different people coming in, they think they're smart, they get wiped out, they leave. And all the time, the people who are doing just the market, just buying index funds, are still there and are still accumulating money. And their money is still growing. So who's smarter? Now, the people who are doing the trading, they think they're smarter, but in reality, it's those dumb index investors, those unsophisticated, dumb investors who just put the money in and leave it there. They turn out to be the smart people in the long run.
Perhaps you heard about Robert Kiyosaki. He's also a financial planner and writes books and advises young people to take leverage. He says that cash is trash, savers are losers, and you should go into debt because this is how money is made. Okay. Do you think, is there any rational way for teenagers to get leverage? Should they ever get leverage, even for, let's say, a diversified portfolio of stocks?
If you borrow money, you have to pay it back. What happens if you don't pay it back? In your country, what happens if you borrow money and you lose it and you can't pay it back? What happens? You go to jail?
No.
Oh, you have to pay it back. I mean, if you borrow something that isn't yours and you don't pay it back, you end up in court. You ruin your life. You don't want to do that. Now, if you need to borrow money to buy a home because you're taking out a mortgage, the home has equity. You could sell the home and you could pay the money back. But if you're just borrowing money personally to go out and buy stocks or buy Bitcoin or whatever, and the market collapses, you still have to pay it back. Where are you going to get the money from? You don't have equity. It's not like buying a home. It's not like buying real estate where you could sell it. So, and you don't have any cash flow from the Tesla stock or the Bitcoin or whatever. There's no cash flow. If you buy real estate, if you borrow money to buy real estate and you rent it, you have cash flow coming in that you could pay off the loan. And then you have the property that you could sell to pay off the loan. That's different. That's not borrowing money to speculate in the public markets or to speculate on something like Bitcoin. It's very different. You have to pay back your debt, or again, there's a saying that in this country that if you borrow, I forgot what it goes, but something along the lines of, if you borrow money and don't pay it back, you end up going to prison. It's not true anymore, but there was a thing in this country at one time called debtor's prison, which was you have to pay back your loans. And to have the belief that you can borrow money personally and put it into a stock or put it into Bitcoin or something else, and that is just going to go up in value, is really living dangerously.
To what extent would you advise someone to take leverage for investing in real estate properties?
Well, again, that's a different investment category. So let's say you're going to buy an apartment, okay? And you're going to lease it out or rent it out. Well, you have to do an analysis of what it's going to cost you for the mortgage or the borrowing the money you have to pay back. You have taxes that you would have to pay. You have upkeep of the real estate that you have to maintain. And then you have a renter. And you figure all that out and you say, well, how much money do I need to get per month in rent? And then you have to go out and find a renter who's willing to pay that amount of money. And so there's this together. In this country, it's generally 80%. So people have to put down on rental and investment properties here in the United States, generally have to put down 20% in cash, and then they get an 80% mortgage or loan against the real estate. And that tends to work out cash flow so that the interest on the loan and the taxes on the property and the upkeep of the property together equals the rent that they're getting from the property. So in this country, it's about 80%.
Yeah, I somehow feel like it's a dangerous play when you go into debt, and the cash flows cannot be always constant. I mean, you can lose rent, you can have lower cash flows.
It's not 100% guaranteed. You could lose rentals, right? Your renter could leave, and it could take you a while to rent it back out again. There could be a flood. There could be a tornado. I mean, all kinds of things could happen to your rental property. It could burn down. You could have bad renters that won't pay the rent, and so. Sorry about that. A second.
No problem.
Okay. So yeah, there's a lot of bad things that could occur with your real estate. That's true, but it is a risk. It's not free.
And you can also.
But it is a form of investing. Again, it's not the public markets.
Mm-hmm.
It's private ownership of a real estate, rental real estate. It is a viable investment diversification should you choose to do that. But now you have to manage the properties. You have to go out and get renters. You have to do background checks on the renters to make sure they're going to pay their rent, that they have jobs and so forth. I mean, it's a lot of work to do that.
And for that work, you have to be compensated with an additional risk premium, let's say. So it's not a free lunch after all.
Oh, no.
Okay, coming back to investing, one of your famous tweet posts was saying that a successful index fund investor goes through 4 phases. Darkness, takes advice from everyone. Enlightenment, realizes the market return is superior to their return. Complexity, overdoing everything to find optimal. And simplicity, invests in a few total market funds.
Yes.
Do you think most people are embracing complexity or simplicity?
What, here in the United States or
Yes,
where?
In the United States.
Most people here are in darkness, which is the first stage. And that is what's going on in your country. There's a lot of people in darkness, where I was saying they think you have information, but you don't have it. You think you know how to trade, but you don't know how to trade. You think that you have superior ability, but you really don't have superior ability. You think that you could figure out ways to outperform the market, but in reality, you can't. And if you did, it's just luck. It's not skill. And this is darkness. Most people are in darkness, even in this country. Most people are in darkness. They think they have an edge. They think they have an advantage, and they really don't. But once they get beyond that, once they realize that they don't have an advantage, that there is no reason for them to have a superior return, that then they have reached what I call enlightenment, where they realize that the markets themselves, just putting money in the markets in an index fund, which gets the return of the markets in a very low cost way, very low cost, is a superior return to darkness. So you get a higher return by just being in index funds. Now, a lot of people in this country are moving to that enlightenment stage. We've seen a lot of money going away from strategies that are trying to beat the markets and moving just to the market return. And this has been helped with exchange traded funds and other vehicles which have become available in the last 20 years. So we have seen this migration of more and more investors over to enlightenment. But what happens after enlightenment is there's lots of different types of indexes out there. It's not just the simple market index. There's indexes for everything. Wind, solar energy indexes, even Bitcoin indexes, and there's innovation indexes and all these different types of indexes that were created to get on the indexing train or the indexing bandwagon, if you will. And so people then started saying, oh, well, I can create an index portfolio using these other types of indexes, and now I can outperform the market again. And they're almost taking a step back into darkness at that time. So they discovered indexing, and they thought it was a great idea, but then they discovered all of these small indexes and they niche indexes and decided that, oh, I can put a better portfolio together of index funds and outperform the market. So they kind of go back to where they were before. And then after a while, realizing that that doesn't work either, that now they're back to where they were. And finally, they get to the last stage, which is simplicity. So they went from darkness to enlightenment with finding out about index funds, then to a complexity, a complex index strategy, and now they're going to go to something simple, which is simply owning the world, owning the entire world equity market. And that becomes the default way of investing, which has turned out better than most. So it becomes very simple at that point, and it's a simple way of investing. So I would say that a lot of people have moved all the way to simplicity here in the United States. There's many more people still in darkness, but more and more people coming to enlightenment and moving through the complexity stage over to the simplicity stage. And I think that if somebody lived long enough, they would get there. But I don't know, some people get stuck. Some people never leave darkness. Some people get into indexing, but they make everything too complex and they never leave that. They want to find a way to beat the market. So we're trying to push more and more people to simplicity. Just a few simple index funds is what you're looking for.
One of your quotes says that complexity is a cost and simplicity is an alpha. And this was my next question. How important is sticking to the plan, and how can you keep a portfolio simplicity in a world of endless combinations of ETFs?
It's very difficult to have the discipline to do this strategy. It's a simple strategy, but it's difficult to implement and maintain because it requires a high amount of discipline to not go off into other strategies that end up hurting you. So again, getting to the point of simplicity where you just have 3 or 4 broad index funds and just holding on to them and maintaining those and not doing anything else is simple, but it's not easy because there are so many distractions out there and so many people telling you, do this, do that, do this. And you're watching people make money. I mean, the only people who get on the internet and talk about this stuff are the people who happen to be on a trajectory upward. The people who are on the way down, they're not talking. People don't talk when they're losing money.
Yes.
They don't. They only talk about when they're winning money. So it appears as though everybody is making money, but it's not true. Only a small minority at any given time is making money. And they're the ones who are making all of the noise. So it appears as though that everybody's making money, but it's just not true. Most people are not. So you have to have the understanding that that's the way the world is really works. People talk about their winners. They don't talk about their losers. They might talk about one loser when in fact they had a lot of losers. They're not going to talk. People don't want to talk about their failures. They want to talk about their winners, not their failures. So all you hear about on the internet are the winners and the winners and the winners. And you begin to believe that, well, how come I'm not winning? And I should be doing that. And that draws you in. And you can't do that. You have to just say that is just noise. And I need to just stay simple and disciplined and let my money grow over time. And that's how you have to do it.
Yeah, and also the problem is you cannot select ex ante those winning stocks. Those people who invest in them are actually chasing momentum strategy. So they are investing when already the stock is performing well. So you cannot know ex ante which one is the best, I believe.
Well, you know how a roller coaster works at amusement park, right? It goes up and 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 then woof. Well, it doesn't keep on going up forever. I mean, there's going to be a time when it goes woof. And if you don't know when to get out, you're going to be done. It's not a good way to invest for the long term. It doesn't work for the long term. It might make you feel good once in a while when you have a winner, but eventually you're not going to have that much money. And the people who just keep it simple, stay disciplined, they will eventually move up. You know, they say the cream floats to the top. The cream floats to the top. Over time, doing this floats to the top. And it has to be long-term. You have, just like your career, you go to school for years and years and years. You go to school to develop a career so that you can earn money. It doesn't happen in 6 months. It happens over many, many, many years of going to school and then going to university and so forth to develop a career. Investing is the same way. There's no reason it shouldn't be. You put your money in an index fund portfolio, and over time it goes up, and you keep putting more money in, and you have more money. There's no quick and easy answer. You can't become a medical doctor in 3 months. You can't become a lawyer in 6 weeks. It takes years to develop your career. It takes years to develop a very long-term investment strategy where you benefit from it during your life and your family benefits from it.
Mr. Rick, do you consider there is a minimum time horizon one should have to be considered an investor? I mean, can you be considered an investor if your time horizon is only 1 year or 3 years? I don't know. There are many like this.
It's semantics. I'm looking to build wealth. I'm looking to build wealth. Okay. That's what I'm trying to help people do. If somebody who is building wealth calls themselves an investor, fine. I'm sure that people who are buying Tesla today and selling it tomorrow are also calling themselves investors. That's, to me, it's semantics. It doesn't tell me anything. It doesn't tell me anything about how you're investing. If you say I'm an investor, that doesn't mean anything to me. It's like, how are you investing? Tell me your philosophy, and tell me your strategy, how you're doing it.
If the stock market is nothing but the discounted present value of future cash flows, where does an investor's edge come from in an efficient market where there are no price errors?
Are you talking about the efficient market theory?
Yeah, so in an efficient market, if let's say the stock market is nothing but the discounted present value of future cash flows, then why
Correct.
should you even expect a positive return after all in the long term?
Because that future cash flow stream is not a certainty. It changes every minute based on every new piece of information that comes in. For each individual stock, it changes on a minute by minute basis. That future cash flow stream and the probability that expectation of future cash flows it will occur changes on a almost moment by moment basis as new information comes in. A new strand of COVID occurs in the UK. It changes the expectations of those cash flows that are way out there. Therefore, the market is leveraged. So you're back here, you're trying to estimate all the present values of all the future cash flows. But now the future cash flows 3, 4, 5 years out go down a little bit. Well, the market goes down a lot. Well, the future cash flows, a new vaccine comes out. Now the future cash flows become more certain. Now they become more certain. The market goes up. So it's a little bit of a change, a very minor change in the expected future cash flows or the probability of those cash flows occurring cause the market to move up and down a lot. There's a lot of leverage in that number. And this is why we have more volatility in stocks than we do in the future cash flow changing. You see how that is because of the years worth of leverage that are there, which causes this. Okay.
I remember that Professor Kenneth French was saying that even for a 20-year time period, there is an 8% chance for equities to underperform treasuries. So thinking about the current market valuations, do you think that the odds are in investors' favor right now?
Do I think that
The
equities will?
if the odds are in investors' favor right now for equities to provide a positive risk premium over the next decade. And
Next. Okay.
also, if you were to invest in one single instrument for the next decade, which would that be and why?
So let's take the first one.
Yes.
Companies borrow money. Right? Those are interest rates. So the central banks are setting interest rates, allowing companies to go out and borrow money. So their cost of capital, the cost of borrowing money, the cost of debt is some percentage. They have to get a rate of return above that on their money. So they borrow money, they go out and they grow their company. They maybe build something or build a new factory or build a new line or build a new industry or do something with it, expand, maybe globally, but they're going to take that borrowing and they're going to grow their business with the idea that the earnings from this is going to be greater than the borrowing cost, correct? Well, what is that number? What percentage is that number? And that number is what we call the equity risk premium. It's the extra return that companies are getting from their borrowing cost to what they expect their return to be. The extra earnings that they get from that after paying their debt gets reflected back into the stock price. So again, we're looking out, saying future value of the earnings based on all of this, and this determines the stock price. So your question is it reasonable to assume, even at valuations of stocks that we have right now, is it reasonable to assume that there will be an equity risk premium in the next 10 years? And the answer is yes, because companies wouldn't be borrowing money now to invest in all of this if they didn't think that there was going to be a equity risk premium. I'll give you an example. I live in Texas, and Tesla is moving right down the road, and they're building a huge truck assembly line, battery assembly line. It's a huge complex that Tesla is building. Well, they expect that will produce a rate of return. Okay, so they going to the marketplace, getting money, taking that money, investing, expecting higher earnings later on down the road, which eventually, if it occurs, because this is the future cash flow, if it actually happens, if they actually make money, it will be reflected in the price of the stock. The stock will go up, which is one of the reasons why it has gone up. It's reflecting this expected future cash flow. So the answer is yes, it is expected. Now, will it happen? I don't know. Because if something happens in the world, maybe interest rates go up rapidly. Interest rates go up rapidly, it changes the equation. The expected earnings fall. And when the expected earnings fall because of the leverage, stocks fall a lot. Okay. And so, boom, it can come down. So for over a 10-year period of time, these adjustments may occur that stocks don't outperform bonds. But the expectation is they will. Whether it occurs or not, we don't know. We believe over a 20-year period of time, there's a much higher probability that it will occur. But over a 10-year period of time, there might only be an 80% probability that it'll occur.
Yeah, and the second question.
But you have 20 years. You're a young man. You have 20 years. I might not have 20 years, but you do. So.
Yeah, and the second question was regarding if we were to invest for simplicity reasons in one single instrument as European investors in UCITS format, of course. Which would that be and why? Perhaps, I don't know, a FTSE All World Global Index Tracker, but it doesn't have small caps. So.
Well, yes, but if it was one fund that you were saying to me, buy one fund, then it would be the All World Equity Fund, even though it might not have a small cap, because I would have to, you would give that up. Okay. But if it was only, you have to look at what's available out there today. What can you invest in?
We don't have, unfortunately, small cap value in UCITS ETFs. And also, I'm not sure if there is any small cap blend premium, because some consider there is, some say no, it's not. Only if you invest in small cap value, you can expect an additional risk premium. Which is the true statement?
So we're moving to a different topic. Okay. So again, if the first is that if I was going to be buying one fund, I would just buy the world equity. Now, what you're questioning is, what about small companies, small cap? And what about small cap value? So you take small cap and you divide it between value stocks, which are in many ways industrial stocks, banking stocks, financial stocks, stocks that have less growth than growth stocks, which are technology stocks, healthcare stocks, things like this. You take the market and you divide it up between value and growth. Historically, value has given you a premium. Now, why has value given you a premium over growth over the very long term? And the answer is because it is perceived that there is more risk in value stocks. They have lower growth. They have higher debt. They have lower book values. And they're less desirable companies than, say, Tesla, right? So because of the extra riskiness of the value stocks, you're expecting to get a higher return due to risk, okay? And the same can be said about small cap stocks. Because small companies have more risk than because they're small, and they can be put out of business by big companies, and they don't have as much ability to go out and raise capital in the marketplace. They have to pay higher interest if they're going to borrow money. So small companies have more risk, they have more overhead, so therefore they should get a higher return. That is the theory. It hasn't actually worked that way for many years, and I think this is Rick Ferri speaking. I think one of the reasons is because it's so much easier now to invest in small cap companies. You can just buy an index of small cap companies. And that wasn't true 30, 40 years ago. You couldn't just go buy an index of small cap companies. Well, now there's many, many, many mutual funds out there that you can buy that are small cap. So you can easily get into this market. So the liquidity of that marketplace has grown tremendously. And therefore, the riskiness of investing in small cap has come down. And therefore, there maybe isn't going to be as much of a risk premium in small cap as they may have been back in 50 years ago when they were looking at the data, because you didn't have the ability to invest in small cap as easily back then. Value stocks could be somewhat the same way. It's very easy now to invest in value stocks because there are a lot of mutual funds out there, or exchange traded funds, UCITS, or whatever, that you could buy at a small cap value. So it's a lot easier now to invest in small cap value if you believe it. So therefore, because it's easier to do, it could possibly mean the risk premium is shrinking. Now, I don't know, but let's go ahead and hedge our bet. If you decide that you're going to do a total stock market index fund, but you want to take a little bit more risk. You could buy a small cap value index fund where you're getting both sides. You're getting value and you're getting small cap, and you put them together. So you buy a total stock market, global market fund, and you buy maybe 20% in a small cap value index fund. Global fund, small cap value fund, 80%, 20%. And you could. Now, wait, let me finish. That 20%, you have to hold onto that for 25 years. Not a year, not 2 years, not 5 years. If this is your strategy to have 80-20, you have to have 80-20 for 25 years in order to have a high probability that it will work and that you'll get the risk premiums. Discipline.
Okay, and if you don't have available any small cap value fund, would it make sense to add a tilt to small cap blend or not?
If you don't already have it in your total world fund, if your world fund includes small cap, then you don't need it. But if it doesn't, if your world fund doesn't include small cap, then you might want to add 20% small cap.
What kind of layers of protections do we have in the financial markets, or do we need in the financial markets, except for diversification, investment horizon, and dollar cost averaging? Should we buy more on corrections to reduce drawdowns length, or this short volatility strategy would be too risky?
You would want to do what's called rebalancing. And this simply means that if you have some money in stocks, you have some money in the bank, in bonds, fixed income investment, and the stock market goes down, then you take some of the bond money and you buy more stock to bring it back up. That takes advantage of the downturn in the market. So if you decided you were going to be 60% in stock and 40% in bonds, and the stock market goes down by 20% or so, so you end up below 50% in stocks, then you take some of your bond money and you buy more stock and you bring it back up to 60. That takes advantage of the down market. Now, when the market comes back and you're at 70% in stocks, you might want to sell some stocks back down to 60% and move the money back over to bonds. This rebalancing is like buying low and selling high, but it's not a hole in and a hole out. It's just staying at an asset allocation between stocks and bonds with discipline by doing rebalancing. And it doesn't have to be very often. Maybe once a year, maybe once every 2 years, maybe only when the market really comes down a lot or the market really goes up a lot is all you really need to do it. You don't have to watch it every day. It's not necessary.
Instead of rebalancing annually, would you consider perhaps keeping a small amount in bank deposits, let's say up to 5% of your holdings, so that you can do the rebalancing more often without selling from your main holdings, let's say bonds, and then generate taxable events?
Yeah, that's a good question. So you mentioned something that we haven't talked about yet, and that's taxes. We want to be very tax efficient on how we do everything. Now, here in the States, we have different types of accounts. Some are taxable, where you have to pay taxes every year on the gains and on the income. And some are retirement accounts, where you don't have to pay taxes on the gains. Okay? So when you're doing your rebalancing and you're going to take a gain, you do it in the tax deferred account. And if you're if you're going to buy more, you could do it in the taxable account. So you have to be very tax efficient about how to do things. And this is a whole hour-long discussion about how to do that. But taxes are your biggest cost. Besides speculation. Speculation is your biggest cost. It's your biggest detriment to return. It hurts you the most to go out and do this and then do that and do this and do that. That hurts you the most. Second, what hurts you the most is taxes. Taxes hurt you a lot. And then third, what hurts you are fees of investing. So bad speculation, taxes, and fees, if you can avoid those, you'll float to the top faster.
Okay, we have checked the Core 4 portfolio website and noticed that even the most aggressive portfolio still holds 20% bonds. Should we always keep at least 20% in bonds despite the very low prospective returns for high quality treasuries?
It's up to you. The way I did the core 4.com, core-4.com website, the way I did that is just having all balanced portfolios. So the most aggressive had 20% in bonds. It wasn't a indication that everyone should have 20% in bonds. That was not my meaning in doing that. It was simply, there's 4 funds and one of them is a bond fund. So the most aggressive would have 20% of bond. If you choose not to have any bonds, fine. You have 100% equity. It's difficult to maintain 100% equity 100% of the time. But if you can, good.
But would it make sense to invest in riskier treasury bonds, like for instance those issued by Romanian government, which is offering 2% yield on euros for intermediate term period, and also you have tax efficiency, so you don't pay taxes and you don't have currency risk, so you have some advantages. Would you consider it? We are in the middle between investment grade and junk, I think, as a country, but still investment grade.
I'm not an expert on Romanian debt, so I really can't answer that. That would be something for you to say. I honestly can't answer that question. If that's what you choose to do because you feel it's stable enough and you're not going to lose your principal. Remember, bonds you're supposed to get your money back with bonds, right? You're supposed to get your money back. So the idea is if you believe you're going to get your money back and there's a tax benefit to it and that it's got a better yield, yeah, I would suppose. But again, I'm not an expert on your country debt.
You have previously discussed about a static asset allocation. Would you also consider a dynamic asset allocation, like for instance, if equities crash 50%, to increase our allocation, our default allocation into equities, let's say from 30% to 50% or whatever?
Well, it's hard to do because now you're trying to pick a bottom of the equity market. And what if you are wrong? Now you've added more money and you've increased your asset allocation to equity and the equity markets continue to go down. How are you going to feel about that? It's hard because are you then going to take money out of stocks if you think the market is high? Are you going to reduce your equity from 50 back to 30? And when are you going to do that? So you have to now make these difficult decisions, not only once, but you have to make them twice. You have to decide when the market is low and buy, and then when the market is high, and sell. It's very difficult to do. What are you going to do if you are wrong? People have a tendency to chase returns, so it could cause you to blow up. It's very hard to stay disciplined with a fixed asset allocation. Just pick the one that you're okay with, where if the market goes up, you say, oh, I wish I had more money in stocks, but you don't increase your asset allocation. If the market goes down, you say, oh, I wish I didn't have as much money in stocks, but you don't sell your stocks. So whatever that medium is, that's where you should be, because that's what's right for you. And I think one of the biggest problems that we have out there is that people try to find what we call rules of thumb, which basically are, if this happens, do this, and if this happens, do that, rule of thumb. But that's not the way people are. You need to find out what works for you, what allocation is right for you, given your situation, that puts you in that complacent, happy medium range, and you do that. No one can tell you, you should be this, you should be that. It doesn't work that way. It comes from you. You realize where you should be, because if you do it from you, where you should be, there's a higher probability you're going to have the discipline to stay with it, and then you'll float to the top over time. It's, again, this is simple, but it's not easy. It's not easy to do. It's better, I would say, it's better to have less in stock if you're going to maintain that allocation than it is to have more in stock. And when the market goes down, you sell everything because you're nervous. That doesn't help you at all. So you got to find what percentage works for you long term. You keep it there. And same thing with real estate, by the way. Real estate, same thing. You have a portion in bonds. You have a portion maybe in real estate. You have a portion in stocks. You don't overdo one or the other. It's you have to maintain a balance that makes you comfortable, where you're able to maintain this strategy for year over year over year over year. That's how you get wealthy.
Yeah, I think William Bernstein has said that personal finance is more personal than finance. So
that's right.
In the end, I think it's not about the rule of 100, rule of 110. We have to do a mix between age and risk tolerance when we set up the static asset allocation. Right?
And your need. What do you need? It's not just risk tolerance, because there are a lot of people who can handle a lot of risk, but they may not need to because they have accumulated wealth, right? They've accumulated wealth, so they don't need to take risk. But yes, and age is not that much a part of this, okay? Yes, when you're young, you have many more years, but when you're older, like me, I'm in my 60s, I still think about my children and my grandchildren when I invest my money, because a lot of it is going to go to them. So even at my age, it's not my age anymore. It's my children's age. It's my grandchildren's age. And so, I don't think age, I think it's overdone. The idea of age and bonds and so forth, I think it's overdone. It's more knowledge, understanding, what level of risk is going to keep you invested over the very long term, that's much more important. And then your need. I mean, there are some people who they really have to take some risk because if, when they get to age 60, 65, 70, they need to have some money to retire because they can't work anymore. So they need to take some risk. So there is a need factor also.
As you have mentioned before, a lot of people are engaging into pro-risk behavior and they are chasing returns. They are chasing higher returns without looking at the risk. William Bernstein has also written a foreword for your book all about index funds, saying that it is a vital roadmap for those seeking higher returns and lower risk. How can we obtain higher returns and lower risk in the current market environment of increased correlations and low prospective returns, since in an efficient market, all asset classes are expected to have the same risk-adjusted returns?
So first off, Bill Bernstein did not write all about asset allocation. I wrote all about asset allocation.
I know. He has written a foreword for your book.
Oh, he forward for my book. Okay, yes, thank you. Thank you for clarifying that. Okay, fine. Yeah. So the correlations, we say the correlations all go to 1. That's what we say. And what does that mean? That means that when the markets become very volatile and uncertain, like they did in March when COVID first took over, that everything that has risk, it doesn't matter what it is, real estate, stocks, doesn't matter. Everything goes down together. Boom. And the only thing that maybe doesn't go down is the money that you have in the bank. Okay, so there's that. And the answer to that is yes, that's true. Is there any way around that? You could leave all your money in the bank, 100%, and you don't have to worry about that. But is that going to get you to where you need to be? Probably not. Life is full of risk. Life is a dollar cost average. Yes, there are going to be periods in your life when things are not going well. And that includes your investment portfolio. But do you give up? No. There are times in your career when things are not going well. Maybe you just got fired from your job or got laid off from your job because of what's going on. Devastating to you. Are you going to just quit working? No. You're going to continue with this. There are low periods. Granted, it's part of life. You live with it. It'll pass. And when it does pass, because you did not get out, because you maintained your allocation, that's where you make the money. You made your money by not getting out in March of last year. You made your money by staying in. You made your money by rebalancing, even though things look very bad, very bad. And the financial crisis that occurred worldwide in 2007 and 2008 and early 2009 was much, much worse than what we saw with COVID. Much, much worse back then. There was almost a global financial collapse that central banks came in and governments came in and shored it up. But the point is that there are going to be much more frequently than we would like these periods when things don't work. It don't work. What can you do about it? Yeah, I mean, what do you do about it when something happens in your career and you get fired or laid off or something? You don't just stop working. You go on. And it's the same thing with the investment portfolio. You have to go on. You have to continue. And that's what you need to do. So yes, the correlations all go to 1. Your real estate goes down, your stocks go down. The only thing that doesn't go down maybe is the money in the bank. That's what's called emergency money. If you need it, it's there, and you wait for the rest to recover, and it does eventually recover. Sometimes it takes a long time, but it does recover. You keep on moving forward. You keep on driving forward. You don't quit.
But you say that you shouldn't use some of your cash pile to invest more when equities decline. You should go with your default asset allocation, right? So cash
I
should
think that's
be.
prudent. I've never seen it where people are able. Well, it people will say again. Remember, we talked about people who only talk about their winners, correct? So people will tell you, "Oh, yeah, I had all this money over here in the bank, and when the market went down, I took my money out of the bank and I put it in stocks, and it went up, and I made a lot of money." Because you hear about those people. You don't hear about the people who say, "Oh, I put the money into the stock market because the market went down, and I took the money out of the bank and I put it in there, and then it went down some more." They don't talk. they don't talk. And then I sold everything. They don't. You don't hear about those people, okay? But they exist. There's probably a lot more of them than there are of the first group. So.
But what about the idea of having a tilt towards the undervalued sectors, like for instance oil and gas sectors, or maybe undervalued regions? I hear a lot of people from financial industry discussing about the fact that emerging markets have both on a return on returns or risk-adjusted returns basis higher potential for the next decade. Since we are young, should we allocate more than 20% to emerging markets? Let's say 40% or 50%.
If this is the strategy that you want to do, and you're going to keep it for 20, 25 years, if this is what you want, then okay. There's a philosophy of investing, which is do it in a very low cost way, low tax way, using index funds. Okay, that's the philosophy. Don't try to pick individual stocks. Don't try to get in and get out of the market. Don't trade, just the philosophy. Now, the strategy that you're going to use, my default strategy is a global equity fund. That's easy. One fund. Boom. You own everything. We talked earlier about small cap value. Okay. Now, small cap value has energy stocks, airline stocks, banking stocks. That's what makes it value, the industries. Okay. But if you wanted to go one step further than that, and you wanted to say, I want to buy airline stocks. Well, that's because I think airline stocks specifically are undervalued. That is a very small portion that you might add as a strategy. I can just tell you that from my experience, there's no way you can know whether airline stocks are expensive or cheap. You just can't. You don't have no information about whether airline stocks right now are expensive or inexpensive. It could be a lot of the airlines are going to go out of business, even with government subsidy. You don't know. Energy companies, same way. You don't know. People bought Exxon Mobil stock when it went from 80 to 50. People thought, oh, great buy. They bought energy stocks then, and then it went down to 30. It's very difficult. I would suggest that if you're going to do that, you do it with just a small amount of money, because you're going to be speculating. You don't know anything more than anyone else. There's no way you could possibly know more than the rest of the investors out there, and you might be putting this money there, and it could be what we call dead money for years. And then what are you going to do? You're going to keep it when the rest of the market is going up? You'll eventually sell it. And I guarantee that when you sell it because it didn't go up, that's the bottom. The next day, it will start going up. It doesn't matter when you sell it. As soon as you sell it, the next day, it'll start going up. I mean, don't do this to yourself.
Yeah.
That's not what you don't need it. It's already in the total market. You already have it. It's already there. If you're doing small cap value, it's already there. You don't need to do that.
Yeah, so I feel that allocating to sectors might be too idiosyncratic bet. But if we don't have small cap value ETFs, and we don't in our country, at least investing more in emerging markets as a broader asset class, would it make sense? And perhaps combining it with some factor investing, some smart beta ETFs which are on the market?
These strategies have to be very long term. You start out with the global market, and for most people, that's where you stop. That's where you stop. All these bets that you're talking about, emerging markets, if you look at the industry groups that make up emerging markets, it's a lot of commodity value type stock. So
yes,
in a way, you're getting more value stock just by buying a little bit more emerging market. If this is what you choose to do, if this is your strategy, it's not the philosophy. The philosophy is you're going to buy an index, okay, and you're going to hold it long term. If it is your strategy to include in your portfolio a larger position to emerging markets, fine. But you have to hold it for 20 years, 25 years. You can't sell it because it's not working next week or next month or next year. You have to have the discipline to say, I think this is going to work, but I don't know when. It might be 10 more years before it works. And then it goes, okay? But if it could be 10 years between here and here. And so you have to be there, and it has to be a very long-term strategy, which is the discipline part of this. If you're not willing to do that, if you're not willing to hold on to this strategy for 10 or 15 years, then don't do it. Just do the total market and be done.
So besides philosophy and strategy, you need discipline, whatever strategy you use, to stick to it 20 years,
Correct.
25 years, not to change it every time.
Yeah, now who has that type of discipline? Who?
Even the asset managers don't, because they close those funds which are not performing well. They close the funds. JP Morgan has closed this year managed futures funds because there were too few investors, so they didn't make any money. So if you take into account liquidity as well, perhaps a global market cap index fund is the best option for most of us.
Exactly. That's just what you get to simplicity. So you have gone from darkness to enlightenment to complexity, which is what we just finished talking about. Now you're at simplicity. Exactly what I'm talking about. For most investors, just holding the global market is all you should do. That's simplicity.
Do you consider REITs as a distinct asset class, and would you include it in a retail portfolio given the high correlation to stocks?
REITs, you're talking about real estate investment trusts?
Yes.
Well, real estate investment trusts here in the U.S. are ownership in commercial property that is taxed here in the United States. It's taxed differently, where the companies, the real estate investment trust companies, don't pay any taxes, that all of the rent flows through to the shareholders of the real estate investment trust. Now, I don't know if that's the way it is in Romania, but that's the way it is here. So it's a different asset class here, and it's a different animal. Even though it trades on the stock exchange, it's actual real estate that doesn't pay taxes. All of the rents flow through, or 90% of the rents flow through to the shareholders. It's actually cash flow. It's not the rent. And then the shareholders pay taxes on that. So our U.S. economy is about 13 to 15% commercial real estate. But the stock market is only 3% in commercial real estate. So there's a lot of commercial real estate that's not in the stock market. So if you wanted, as a strategy, if you wanted to have your portfolio look more like the economy and less like the stock market, you would buy a 10% extra position in real estate investment trust. That makes your portfolio look more like the economy and less like the stock market. The stock market is nothing more than how companies capitalize themselves, how companies bring in money to function. Real estate is done mostly differently. It's mostly private. So, but in order to get your portfolio to look more like the economy, you would have to add real estate. Is it worth doing that? Again, are you willing to hold on to this real estate for 20 to 25 years? And what type of an account are you going to put it into? In the United States, we have accounts that are sheltered from taxes. So you would put this real estate fund in that account because it has a lot of cash flow that you would have to pay taxes on. You probably wouldn't put it into your taxable account because it would be a lot of cash flow coming in that you would have to pay taxes on. So you could buy 90% global stock market, 10% real estate, and that could be your strategy. Is that going to benefit you? Maybe. I don't know. It has, in the past, it has given you a slightly better return adjusted for risk. It has. Will it do that in the future? I don't know. I don't know. Now, as far as the correlation between real estate and stocks, most of the time they do go up and down sort of together. But there are times when stocks go down and real estate goes up. So there are times when it's called negatively correlated. Not often, but it does happen. And then you could do a rebalancing to get back to your 10%. Again, this is all strategy. The simple solution is you don't worry about it. You just buy the global market and forget about all of this other stuff. The industry groups, including real estate, small cap value, emerging markets, just forget about all that. You buy the global market, you will do better than 90% of everyone else if you can maintain the discipline.
Do you think gold has a place in an investor's portfolio, and why? And what do you think of Bitcoin, which is considered by some financial advisors as digital gold?
Digital gold. Okay. A lot of people include a little bit of gold in their portfolio because over 3,000 years, gold is a median of exchange that is held pretty constant. There's been spikes all along the way, but over the long term, gold is the inflation rate. It basically is the same return as the inflation rate. Now, if we look back during the Roman Empire, and we looked at what gold bought back then as far as wages, a lot of the Roman officers in the military were paid with gold. And we could look and see, how much were they paid? And pretty close to what the comparable amount a military officer would be paid today, even though it's 2,500 years later. So gold holds its value relative to the inflation rate. If somebody wanted to have 5% in gold, I'd say, okay. But in the long term, by the way, as you move along, it's not a straight line, right? It goes up, it comes down, goes up, comes down, goes up. There's a crisis, gold goes up, and then it comes back down, and then, So if you held a little bit in gold, okay, you would have to sell when you have a spike, like right now. You'd sell back, and then when it goes back down, you'd buy back to your 5%. So you would do a rebalancing. If that's your strategy, okay, as long as you're going to hold on to it for 25 years, and you're not going to sell all of your gold when gold comes down and doesn't seem like it's ever going to go up again, fine. Okay, I don't have any issue with that. But gold pays no interest, pays no dividends. If you put a gold coin in a safe, 100 years from now, when you open the safe up, there's not 3 or 4 gold coins there. There's still only one. So there's no growth, no interest, no dividends, no growth. But it does maintain a median of exchange value over the long term. Now, what about Bitcoin? Bitcoin is trying to be like gold, but it is much, much more volatile at this point than gold. And it's not a median of exchange right now. Now, well, people will accept Bitcoin as a median of exchange, but the volatility of Bitcoin is way, way too high to be any kind of a reasonable median of global exchange right now. I mean, now it's just a speculative thing, speculate. And nobody, people all over the world are buying Bitcoin only because it's going up. Okay, but the point is that if it actually is supposed to be like gold, then eventually it will just become the inflation rate. That's what it should become. And all of these spikes in between are nothing more than speculative bubbles that occur. There's no reason why any of these cyber currencies should be doing this except speculation. So, and by the way, I don't know how high is. I really don't. I have no idea. Today could be the end. This could be the peak. I don't know. But in the end, if it's supposed to be a currency, then it needs to be much more stable than that.
When we are close to retirement, let's say, we also have to think about adjusting our safe withdrawal rates within our portfolio. For instance, Vanguard proposes an adjustable withdrawal rate with a ceiling and a floor. How can you manage the sequence of returns when you are close to retirement to avoid the bad outcomes? And also, how can you estimate ex ante the safe withdrawal rate of your portfolio? Let's say you have 50% global equities and 50% bonds. This is your allocation. And you want to know how much to withdraw so that you don't get out of money.
Retirement, which I work with a lot of retirees, that's not even a discussion, not a discussion. This is a discussion for people who are perhaps saving for retirement, maybe your age. People who are retired, this is not really a discussion because they have bills to pay. They have expenses that need to be paid. They have to pay their electric bill, their phone bill, the heating bill. They have to eat. They have to pay for their car, put gas in their car, and so forth. So they have actual expenses that need to be paid. And in retirement, withdrawal rates are not hardly discussed. In retirement, it's all about cash flow. Where is the money coming from? You have stocks that are going to pay dividends. You have bonds that are going to pay interest. In this country, we have something called Social Security, which is a government type pension that pays people. And everybody who has worked and paid into the Social Security system gets a pension. And all of this added together should equal how much you spend. And if it doesn't, if the money coming in, if you're spending more than that, now you're eating away at your principal. And the question is, how much do you have and how long will it last? And the way, if you're eating into your principal, if you're using principal to live on, instead of the dividend, if you're getting dividends and interest and Social Security, but now you also need to draw from your portfolio, it's a dollar amount that you need to take out. And so you might have 4 or 5 years worth of this amount in a bond fund, okay? So that if the market goes down, you don't sell stock, you leave it. You sell some of the bonds. You take the money from the bonds. It could be 10 years worth of this living expense. You could have 10 years. And some advisors do say 10 years. So you take it from the bonds. And by that time, you hope the stocks have come back. So the sequence of return risk and minimum withdrawal rates, when I am talking with young people, I say 3%. If you look at when you're 65, how much do you think you'll have accumulated? Let's take 3% from that. And that's about what you could take out of your portfolio. That's a planning number for younger people. But once you get to 65, it's no longer about a percentage. It's about money. It's about how much you actually need to live on. And in some cases, what we know is that people, when they retire, will cut back on their spending. They'll cut back and they'll spend less. They'll, what we call, downsize. And that has a lot to do with it also. So also the part of the sequence of return risk, besides having several years in bonds, is changing your spending habits. Not going on vacation as much, not eating out at restaurants as much. If you have 2 cars, maybe you now only own 1 car, and downsizing so that your spending drops at the same time because you don't want to take any money or more money out of your portfolio. So that's how you deal with this sequence of return risk. Go ahead.
Let's say that the equities part, which were 50% of our portfolio, declined with 50% and bonds remain intact. So we have 20% less at the overall portfolio. Now we withdraw 3% from the new number resulting after the decline or from the initial amount before the loss.
It doesn't have anything to do with the percentage. It has to do with your bills. How much do you need? You can't stop eating.
I know, but supposing that we can reduce some of the spending, this 3% has to be from the initial amount before equities declined.
A lot of times it's not 3%. It could be less than that. I mean, it's not. Your 3%. The 3% number assumes that that when you die, there's still the whole portfolio there. All right, so you haven't taken any money out. It's all still there, and then your children are going to inherit it. Well, maybe they'll inherit less money. Maybe you need to spend some of the money. Maybe don't worry about spending the money. Maybe they get what's left. And if you have equity in your home, you could take some equity out of your home and spend that as well. Well, what I'm saying is that in retirement, it's not about the 3% withdrawal rate. You protect from perhaps sequence of return risk, but it's all about cash flow. It's 100%. What do I spend? Where's it going to come from? What's it look like? And if I'm not going to get that amount of cash flow and I'm going to take from the portfolio, and there are times when the portfolio goes down and I don't want to take from the portfolio, what can I cut? What can I cut so that I don't have to take from the portfolio? So it's cash flow. It's all about cash flow. And so the 3% rule, 4% rule is a planning tool, but it's not actually used once somebody gets to retirement age. I know, because this is what I do every day with clients. So every day, it doesn't even come up. It doesn't really come up, except for people who are in their 30s and 40s. As a planning thing, what could you take out? What could you take out? As opposed to what will you take out? It's different.
Which do you consider being the role of financial advisors today, given that you cannot beat the market and do active management? And what do you usually discuss with your clients who are asking for an advice to manage their portfolios?
So the role of the financial advisor today is to do what we are doing here. Have a discussion and talk about concepts and help them figure out how they should get this cash flow from the portfolio to live on in retirement, what their portfolio would look like or should look like, how taxes work in retirement, because they are different, and how medical costs are work. And so it is understanding how the systems work, the government works, and helping people discuss this to put together a plan for them where they could manage their personal finances. I mean, that's what I see as the role for a financial advisor. And we're helping people, and everybody's different. Everyone is different. There's no two people alike. There's different experiences, there's different incomes, there's different family, different health. Everybody's different. So you have to learn about your client, spend a lot of time asking a lot of questions, and then understanding taxes, markets, asset allocation, health care, retirement, and help put together a plan for them to either prepare for that because they're young, so to prepare for it going forward. It might be children's education, buying a home, prepare for that. And then once they get to the point where they're going to retire, help them transition into it and ensure that their financial well-being is good through the rest of their life. That's what a financial advisor should do. Now, in this country, there's lots of people who call themselves financial advisors, but they are not financial advisors. They are selling products. They're trying to sell you something. They want to sell you insurance, or they want to sell you this mutual fund or this limited partnership, or this or that. But they call themselves a financial advisor. They're not financial advisors. They're salespeople. And they ought to know what they are and avoid that. And there are also people who are money managers. They manage investment portfolios. So their role is to manage the portfolio. Now, are they advising you? Somewhat. But really what they want to do is they want to manage the portfolio and get fees from managing that portfolio. So their whole discussion is about them managing your portfolio and getting paid for managing your portfolio. Are they advisors? No, they're money managers. They're portfolio managers. Advisors, the way I look at it, are people who are just giving advice and are getting paid, like I do, just get paid for helping people by giving advice. And then when they don't need any more advice, okay, we're done. So I get paid by the hour for helping people. And they pay me, and I'm done. And that's what I consider really a true financial advisor. And I know that the term financial advisor is very People get confused by design. The financial advisors that are doing sales, the financial advisors that are doing money management, they want people to be confused as to what a financial advisor is and supposed to do, because that way, if they can call themselves financial advisors, the clients might say, people say, I have a financial advisor. It turns out it's not a financial advisor. It's somebody who's selling you very bad, expensive products. So that's not advice, that's sales.
So basically, you are a fiduciary advisor for retail investors, for do-it-yourself investors, whereas many other are selling your product. I can tell you what happens here in Romania. In Romania, there are almost no financial advisor. Everyone is in a conflict of interest. They are either actively managing portfolios for getting fees, right? Or even worse, they are making money from selling you products where it's clear that you're losing money. Like, for instance, unit-linked insurances or peer-to-peer lending, these shadow banking systems, if you heard about them, they are very popular among teenagers. Or investing in junk bonds. They have some partnership with some firms which are issuing junk bonds, and they are saying, go invest here, you'll get 6% at euros, and it's a wonderful yield. And people don't know the risk, they cannot assess the risk, and they risk losing all their capital because they trust these people who know to sell very well, to do sales. And also, some of these advisors, of so-called advisors, are profiting from asymmetry of information. So basically, they know that Romanians are lacking financial education, and they are selling them some beginners guides or investing courses at very expensive prices, and courses in which they also sell other products. So basically, they are not offering information or high quality information. They are practically scamming the beginners, those who don't have enough knowledge. And nobody seems to care, because even those who are beginners trust these people because they promise them high returns. So how can you protect
No,
yourself?
wait. That's not true that nobody cares, right? You care. And you're doing this podcast, and you're trying to educate your fellow citizens on what's going on out there. So yes, you care, but it's a grassroots effort. I mean, the same thing in the United States. We started Bogleheads.org website because it was the same thing. Nobody cared. Well, we cared. And so we started the website, and we started putting up information for free so that people could educate themselves. And that's grown to millions of readers. And it's done wonderful things for investors here in the United States. And I know that there are people in Romania who read the Bogleheads and listen to my podcasts, because I see that. I can see it on my analytics that people from your country read it. So the fact is, there are people who care. But unfortunately, you're not going to get much help from the government. You're certainly not going to get much help from the industry. Why would they want to help? It's a grassroots effort. And people like you are doing a wonderful job educating your fellow citizens. And you just got to keep on doing it and doing it and doing it and doing it and doing it. I've been doing it for 25 years. I don't know when I'm going to lose my voice or lose my mind. Jack Bogle, who started Vanguard, did it until he died. And this is what it takes. And so there are people who care, and you're one of them. And I'm sure that people thank you for what you're doing.
Yeah, but we are still a minority in the vast majority of scammers.
You're always going to be a minority. We're still a minority here in the States. But over time, we have made a big impact. Over time, it took many, many years, decades. It took decades to educate people. The first index mutual fund came out in 1976. That is 45 years ago. And it's only been in the last 10 or 15 years that index funds have really started to grow. It's taken a generation of investors to embrace these things. But you know what? You have to start someplace. You have to. And you are. So this is it. Just keep on going.
Have you actually met John Bogle? the father of index investing?
Yeah, he wrote the foreword on one of my books, The Power of Passive Investing. And no, I've known him for many years, and he was a genius, wonderful man, very caring of other people, and he wanted to make a difference. He could have made a lot of money, but instead he chose to make a difference, and he did. And yes, I knew him, and of course we all miss him very much.
How difficult was the transition from the military career to a career in finance, and which was the main trigger for your interest in investing?
Well, I've been interested in investing when I was a teenager, and that started it. And I went to my undergraduate university was in business and economics, so I was always interested. And then I went in the military, flew fighter aircraft, as you said. The transition out into financial services was interesting. I didn't know, again, I was in darkness. I didn't know that I thought the brokers, the salespeople, I thought they were actually analysts. I thought they were knowledgeable. I thought that they were interested in making money for their clients, interested in then making money for themselves and their firm, but they would put their clients first. That's what I thought. And so when I came into the financial services industry, I first went to work for one of those brokerage companies on Wall Street. And it wasn't very much longer, I began to question whether they had the client's best interest at heart. And as I continued in the brokerage industry, I realized that they did not. And after several years, I decided to leave and start my own money management company where we would manage investment portfolios of index funds. But the military training causes you to seek what is real, and what is fake, what is not real. And when I was because your life depends on it in the military to seek what is true and what's not true, right? And so when I went into the industry, that's the mentality that I had. I want to find out what is true. Not what I was told. I want to find out what is actually true. And that caused me to embrace this concept of low-cost index investing after about 7 years, quite frankly. It took me 6 or 7 years before I finally embraced it. And then I said, this is true. This over here is not. And then I ended up starting my own company eventually and leaving the industry. So, yeah.
Do you think that everyone starts with this idea that he can somehow outsmart others, outperform the market, and then suddenly realizes that it's not possible?
Well, it's just not possible.
It's hard.
Okay, it is possible. It's not probable. And then there's no reason for you to have that information that you need. In other words, to outperform the market, you must have superior information that others do not have. I mean, you must have that. If you just have the same information that everyone has, then there's no reason for you to outperform because everybody has the information. So you must have superior information. Why would you have superior information? Why? Where did you get it from? Now, you could have gotten it illegally. Okay, well, that's fine. Like in the United States, if you get it illegally, you go to jail. But if you don't get it illegally, if you try to get it from the public information that's out there, why would you have more information than everybody else. You don't. You have the same information as everybody. Now, and secondly, even if you did have superior information, you have to know when to buy and when to sell. So you've got the information. When should you buy and when should you sell? Why would anybody have that? Unless you're an insider, where you wouldn't have it. So there's no logical reason why you would outperform unless you got lucky. You can get lucky. But you pay a lot of fees and taxes trying to get lucky. Is that really a good way to build your retirement fund, to try to get lucky? No, it's not. Now, you might take a little bit of money and put it aside, and say, okay, this is my lucky money over here. This is my small account that I'm going to try to get lucky with. Okay, fine. But the rest of your money, most of your money, you just be in a broad market index fund and a fixed income bond fund of some sort and some bank money. And that's how most of your money should be invested.
The last question. What do you think is the best way to develop a long-term investment mindset? Books, blogs, social media, podcasts?
Yes. Everything.
All of them.
All of them. Yeah. All of them. However works for you. With me, it was books. I read books and studies. But now you have podcasts, social media, Bogleheads.org. I mean, there's more available. So whatever works for you.
Thank you very much, Rick Ferri, for accepting my invitation. And it was a great pleasure to discuss with you today. I hope everybody realized that. It was a great discussion we had today with Rick Ferri. I think it was the best Christmas present for our investing community. And really appreciate sharing with us your wisdom, since I know from your website, rickferri.com, that your time is very valuable. You have a default hourly rate of about $900. And I would like to thank you very much. I wish you a happy and also healthy new year. And may 2021 be a better year for us all. Now, famous last words are yours, Rick Ferri.
Well, I want to thank you for inviting me. I think what you're doing is extremely important in your country, and I hope that you keep it up and never give up. Just keep on plugging away. At times, you think that it doesn't work, it's not working, it's not going anywhere, but it is. You're making an impact, and you just continue to do it. And your listeners, those who are enlightened, those who have gotten to the idea of simplicity, should tell other people. Spread it around. You're not going to get it from the financial services industry. You're not going to get it from the government. You can help your friends and help your relatives. If once you become enlightened and once you have understood simple investing, long-term investing with discipline, tell other people. They're not going to listen. They won't listen. Doesn't matter. You tell them again and again and again and again and again. And if they hear it enough, eventually they might too become enlightened. Anyway, thank you very much for your time.
Thank you very much, Rick Ferri, and have a very good and happy new year. Bye-bye and all the best.
Bye now. Take care.